A company can maintain an immaculate balance sheet and steady revenue streams, yet suffer a total structural collapse from internal pressures traditional accounting never sees. For decades, management relied on pure financial performance measures to judge an organization's health. Metrics like return on investment, residual income, and economic value added were the primary tools for evaluation. This timeline shows why this approach fails to guide future decisions. Data points for ROI and EVA only appear long after the corresponding events have passed. They are strictly lagging indicators, reporting what has already happened while leaving the future completely blank. A profit and loss statement is a static record. It lacks the mechanism to coordinate the daily actions of thousands of employees or direct their behavior toward a specific strategic target. Reaching those targets requires an organizational structure that outlines the exact roles of individuals and allocates authority and responsibility specifically to attain those objectives. This necessitates a transition from the static balance sheet toward a dynamic performance management system. To secure long-term viability, companies must look past pure finance and deploy frameworks that mathematically account for variables like quality, sustainability, and human capital. Operating solely on financial data creates a structural imbalance. It requires a counterweight of non-financial measures to provide a complete view of organizational capability. This is the Balanced Scorecard, developed by Kaplan and Norton. It connects non-financial operations to financial outcomes by evaluating the business through 4 specific perspectives. The customer perspective asks, how do customers see us? To meet those expectations, the system links directly to the internal perspective, which asks, what internal processes must we excel at? Supporting those processes is the innovation and learning perspective. Can we continue to improve and create value? Finally, that improvement feeds the financial perspective. How do we look to our shareholders? Creating this scorecard follows a strict sequence. Management identifies the vision of where the organization is going, formulates strategies to get there, and then determines the critical success factors for each perspective. Those success factors are then broken down into measurable key performance indicators, KPIs, and specific action plans. Consider a retail bank using this model. Their primary financial goal is to increase overall profit. To hit that profit target, the bank sets a customer goal to reduce loan wait times. This requires an internal goal of digitizing the loan process, which in turn requires an innovation goal, training staff on a new AI platform. The power of the Balanced Scorecard is this chain of links. It translates a high-level strategic vision into quantifiable daily targets for the entire staff. Within the internal perspective, quality is not a vague standard. In a modern performance measurement system, quality is a strictly quantifiable cost dimension. This graph maps the economics of quality. The x-axis represents the rigor of the quality management system, while the y-axis tracks cost. The first line is the cost of conformance, the expense required to meet quality standards. Conformance includes prevention costs, like staff training, and appraisal costs, such as product inspections and quality checks. If those standards are not met, the organization incurs the cost of non-conformance. This is divided into internal failure costs, like scrapping defective parts, and external failure costs, such as warranty claims and product recalls. There is an exact inverse relation between the rigor of the quality management system and the costs of non-conformance. As the rigor of the QMS increases, the costs of failure drop. For a smartphone factory, spending $1 million on automated testing prevents a potential $50 million external failure recall. Because what gets measured gets done, linking staff rewards to these specific KPIs alter worker behavior toward higher precision. This system is supported by lean production, which focuses on cutting out waste to ensure the right product reaches the right place at the right time. It also requires a functional management information system to provide the reliable, timely data necessary for effective control. Treating quality as a hard financial metric allows companies to mathematically prove the return on investment of preventing errors before they occur. While factory metrics handle internal efficiency, a company's long-term viability also depends on its external impact. The triple bottom line framework measures performance across 3 dimensions: planet, people, and profit. We can see this in the reporting for SX Ltd. Under the planet dimension, they track their environmental impact through initiatives like reducing plastic packaging and constructing solar-powered warehouses. Under people, The company reports social initiatives like funding local hospitals and childcare. Under profit, it records the traditional economic returns generated for shareholders. These frameworks, the balanced scorecard, cost of quality, and triple bottom line, are not distinct disciplines. They are different lenses on the same strategic truth. Research by David Otley in 2005 identified a common thread between the balanced scorecard, the performance prism, and the results and determinants framework. Otley observed that effective systems maintain a balance between financial and non-financial measures, regardless of the ease of measurement. Every significant factor must be linked directly to corporate strategy. These tools coordinate external market demands with internal operations to ensure the successful execution of the corporate strategy. Strategic performance management unifies these metrics into a single field that links human motivation to the long-term survival of the organization. Applying these management frameworks in the real world requires a strict understanding of the specific structural formulas used in strategic policy formulation. Pure financial measures, return on investment plus residual income plus economic value added. The performance management system flow. The strategic goal dictates the critical success factors, which are then measured by KPIs. The balanced scorecard, customer plus internal plus innovation and learning plus financial perspectives. The cost of quality, conformance, prevention and appraisal, plus non-conformance, internal and external failure. The triple bottom line, planet plus people plus profit. These formulas provide the structure for integrating financial and non-financial measures into a cohesive strategic plan. Strategic performance management makes the drivers of long-term value, quality, people, and the planet, highly visible, measurable, and actionable.